Anshul Sehgal is also joining us on the show. Kunal Nuresh, of course, are with us. Anshul, morning. Anshul, what are you making of this rural recovery narrative which is now emerging in the market? Four big companies back to back. I'm sure they wouldn't know that the respective management would almost sound similar. You could talk about Britannia, and in fact, all the numbers came Marico, Dabur, HUL within 2 days, right? And there was almost a same kind of commentary and green shoot argument being given by all of them. What are your thoughts there? And would you also play not just direct beneficiaries like consumer stocks, Daburs of the world, but also say tractor segment or the other rural-led basket?
Morning, Ajay. Pleasure to be with you. Um, Actually, rural is a very interesting story because if you look at rural stocks, rural linked stocks, then over the last, say, 2 to 3 years, many of these stocks have fallen by nearly 30 to 50% at a time when the markets are hitting all-time highs. So there has been significant bearishness in this space because the rural economy was weak. But as you rightly mentioned, four large companies, and I've had a whole host of calls with smaller companies, which are all indicating that green shoots are, after a long time, quite visible. And if that were to play out, then clearly there is no expectations built into these stocks, which are rural linked. And there could be, with this low ownership of this space, there could be quite a bit of interest going forwards in the next 1 to 2 years in this space. And risk adjusted returns in rural linked stocks could be quite significant. Now, you could play it through various segments, subsegments within the rural economy. You could play it through the FMCG plays or discretionary rural linked companies, or also the names that you mentioned, agri-related tractors, etc., those kinds of companies. So, whatever segment one is comfortable in understanding, I think that is a segment to get into in this space because the tide is definitely rising, and that rising tide will pick all boats up. And so one will have to choose segments as per one's own understanding, but this is a space where we see risk-adjusted returns being made in the next few years.
What about the PSU rally? How do you see that playing out over the second half of the year?
Hi, morning, Aban. So, if you look at the PSUs in general, while there has been significant rallies in that space over the last few, I'd say, months and quarters, and many stocks are up. In fact, yesterday I was reading a message that was sent to me. HAL used to trade at 24,000 crore market cap around August of 2020, and that stock today is over 3 lakh crores. So as much as 12 times rally in a matter of 4 years. That's what has happened in some of the PSU names where there are tailwinds in demand. I could say some similar things about railway stocks because we used to own a few in our portfolios, and there was a ton of money made in that space. But if you look at the aggregate of PSU stocks and compare to previous highs, which were made sometime in the early 2010s, you would notice that valuations are on price to book and price to earnings are still between half and 1x of previous highs. So there is significant room for these stocks to further re-rate from here. Now, the question is whether demand patterns will remain the way they have been in the recent past. And in many segments, we have to give it to these companies that they have performed very well. Efficiency has gone up. And these are companies which are largely monopolies in the respective segments. Say in defense, missile technology, aircraft technology, in railways, railway infrastructure, in lending to power sector, again near monopolies. Um, Lots of segments are monopolies in this space, and there will be interest. There is bound to be interest in this space. And if the current establishment comes back, then this is a space, this cyclical sort of segment of the market, which will be further, I mean, there will be further interest in this space, and there could be further upsides. Again, easy money has been made, but there is still money on the table, and one will have to choose pockets.
Anshul, what are your thoughts on the way Restaurant Brands Asia declared their numbers yesterday? I mean, it's been languishing for a very long time. Just pull up the 1-year chart and you would see what I'm talking about. But what happened was that even when we spoke to the management time and again in the last 4 quarters, despite of the slow, dull phase they were in terms of SSG growth, the company didn't scale back on their store rollout plan. They kept on adding stores. At 102 odd, the valuation right now, and after the only company QSR in the space, which is coming out with 6% positive SSG growth, would you be looking at this underperforming space constructively or not quite?
Ajay, this is a space where companies are adding to their capacities, not keeping in mind the next quarter or 2 quarters, but they see demand over the next 2, 3, 5 years, and they're gearing up for that demand. Of course, in the near term, there has been SSG weakness, and like you mentioned, I mean, I don't follow this company, but I can understand that there has been a beat on expectations on SSG in this space. But over the next few years, QSR and outside dining, that space could really take off. I mean, we have to keep in mind that for now, we've had urban consumption being strong, and even that in pockets. Rural consumption, tier 2 pockets, consumption has been weak. If the investment cycle turns into a consumption cycle, which is something that we have seen over previous times, then clearly this space is one area where there will be a lot of demand. And just like in hotels that we are seeing just now, where there is no capacity, we will see shortfalls in capacity in this space, and upsides could be material. So this is QSR space is quite interesting in my judgment.
Kunal, let's get in some chart checks going. I think it's been a pretty phenomenal week for Ircon International, apart from yesterday's price action. What are the charts reading like? Not asking for the stars. And give us a view as well on what stands out for you within the real estate basket.
So I think railways as a pack overall has been very, very attractive. In fact, many of the stocks within the railways are now inching towards a breakout. So I think it's a fresh lease of momentum, volumes for these stocks, and I think when volumes get into much more stronger side, then we expect the breakouts to be much more stronger and durable for many of the spaces. So I would probably believe that railways is one of the other spaces which I believe could come back into momentum after almost 3 or 6 months of correction, consolidation, etc. for many of the railway names, and that would include the likes of IRFC, RVNL, RailTel, etc., where many of these stocks have gone through a 15 to 25% broad correction over the last 3 odd months. Now, from the real estate pack, I would actually stick with the two traditional names which I've been highlighting over the last two and a half odd years. So, the likes of DLF as well as Anant Raj. I think both of these stocks are still looking very attractive even from current levels. In fact, DLF has already gone through a patch of a 10-15% correction. It's come back towards 850-ish kind of a range. Anant Raj is still holding up quite strong at 370-375 mark. So I think both of them continue to be attractive. Godrej Properties is the other name which has given a breakout of the charts. And when you look at this relatively with respect to the 2021-22 highs, the stock is still looking quite strong in terms of a potential up move further from current levels.
Right, okay, those are some of the buzzers in trade. Naresh, have to address what happened to Hindustan Aeronautics yesterday and the kind of tizzy that the stock went in.
So it's been an interesting trend out here. It just does not stop ever since it got breakout back in 2023, a fresh one. And before that also, it's been a massive mover. So for now, what happens is yesterday was a very large volume day. It is getting into overbought zones, but the trend is still strong. So the way to trade right now is to ride on to the position, have a trailing stop loss below 4,200. At current levels, it does not become a buy because the risk reward is just way off and the stock has gone up massively. From a time where it had to be bailed out to the time where LIC has been able to sell more than 10% of equity. So massive run. Going forward, there could be a time over the next few weeks where it could actually top out for the short to medium term.
Anshul, the other space which you like is cap goods. Again, a similar phenomena played out this quarter, just like consumer. Siemens, ABB, all of them came out with not only good set of numbers but great commentary. Isn't the valuation argument becoming challenging here, or one should still get into some of the bigger cap good names, or would you look at the mid caps?
Ajay, my firm belief is that you will never get Balkeshwar at Mira Road prices. And these companies you could say are akin to Balkeshwar. High quality companies. There will always be interest in these companies from the investor community in general. These are companies where technology leadership, not just in India but globally, they possess, and as a result, they will always be at premium prices. I still recall Siemens used to trade at between 500 to $1,000 a few years back, and at that time it used to look expensive. Now it trades at, I think, 7,000 plus rupees. So quality will always trade at a premium, and if growth comes in quality, it will obviously be re-rated up. Now, given where they are today, of course, as I earlier mentioned, there is easy money off the table. From here, one will have to be cautious in some of these names, because if your time horizon is the next 6 months, 8 months, you don't know whether prices are going down or up. But given where the India cap put cycle is, we've really not invested in capacities for the better part of the last decade, and that capacity addition is only just starting. We have to keep in mind that our gross fixed capital addition used to be in the range of 35%. At peak, it came down to 27%, and we are only at 29 to 30% today. This number, if it goes back to previous peaks, then clearly the upside in many of these capital goods companies is unfathomable as we stand today. And in our judgment, we are only at the start of this cycle. China plus one, geopolitics in general, the turn towards manufacturing, make in India, PLI, all of these things are a heady mix for capital goods companies in India to do very well over the next 3 to 5 years. So I'm a bull on this space. Of course, short term, there can be ups and downs because of market volatility. But say 3 5 years, very little chance that you will lose money here. In fact, you'll make a lot of money.
Anshul, when it comes to the auto segment, you think the bigger play now is in the entire rural recovery theme, and maybe some of the farm equipment majors is what one should bet on, considering PVs have definitely had their days in the sun already?
Morning, Aisha. I think that you're right. That is again where you'll find more opportunity, because valuations are more reasonable than some of the other PV oriented companies. But again, the sort of penetration of autos in cities, in tier one, tier two towns, rural areas is just so minimal in India that the room for upside, and if we were to compare ourselves to a China, etc., the kind of cars they sell on an annual basis, we are probably less than 1/10 of that number today. Now, we also have to keep in mind that China is 11,000, 12,000 per capita income. We are 2,500. But we also know this 2.5 is going to 4,000. There is nothing stopping that. And when that happens, demand for discretionary products like cars, two-wheelers also goes up markedly. And our belief is, as a result of that, PVs, two-wheelers, and of course, farm equipment and farm-related companies, all of those will see tailwinds. This space, again, is cyclical. You will see cycles here, but longer term, 3 5 years, again, here there is a lot of money to be made. And then if you're a stock picker, you can of course identify and pick segments within autos where you will make money, even auto components, etc. So interesting opportunities here, Aisha. I can tell you that I've been finding quite interesting opportunities, still cheap in this space.
Okay, great. Anshul, thanks as always for taking the time out and sharing with us that perspective.
It's my pleasure. Thank you.
If you like this video, then like, share and subscribe to ET Now.